Hello, everyone. Today we're going to discuss mortgage interest rate buydowns, what they are, how they work, who they're for compared to who they're not for, and to help you make a better decision as to whether you should do it or not. So let's get right into it. Every interest rate comes in three versions. It can either come at a discount, where you have to pay in order to get a lower interest rate. It could come at par, where there is no cost in order to get that rate and no benefit in order to get that rate. And the last is at a premium, where if you take a higher interest rate than par, it will give you a premium to reduce your closing costs. So what exactly is an interest rate buydown? You're paying money up front, or money is being paid up front in order to get a lower interest rate and a lower monthly payment. So who can pay in order to get this interest rate buydown? There's a few different ways. The first is you, as a homeowner. If you already own your home and you're refinancing, you can buy down your interest rate to get a lower monthly payment over the life of the loan. Second option is the seller. In order to sell you the house, they could tempt you a little bit more by paying part of your closing costs in the form of a seller's concession to help you to buy a lower interest rate and monthly payment. And the third is a builder. A builder can contribute their own money in the form of a seller's concession in order to help you to get a lower interest rate and monthly payment to tempt you to purchase that house or to motivate you to purchase that house. So what are the different buy downs that are out there? The first is a 2-1 buy down, where in the first year, and by the way, all of these figures are fictional and for illustrative purposes only. So in the first year, let's say you would get an interest rate and monthly payment related to 5%. The second year, your rate would move to 6%. And for the third year, through years 30, your interest rate would move to 7%. And of course, there's a cost for this. The other option is a 3-2-1 buy down, where the first year, your interest rate would be 4%, the second year, 5%, the third year, 6%, and the fourth year, through year 30, it would settle at 7%. And then the last option is the one that most are familiar with, where you're simply paying a dollar amount and or a percentage in order to get a lower interest rate and a lower monthly payment. For our purposes, we could say you're paying $6,000 up front in order to reduce your monthly mortgage payment by $100. So some might say, wow, that's crazy. That's a lot of money just to give you $6,000 just to lower my payment by $100. But if you take that $100 and multiply it times 360 months, which is 30 years, you're actually saving $36,000. So in order to find out if it makes sense for you, you personally need to do a break-even analysis. So what you're doing is you're taking the total cost, which in our case is $6,000, divided by the monthly savings, which in our case is $100, and you come up with 60 months. So your break-even point is 60 months and or 5 years. So for the first 5 years, you're not saving any money. After 5 years, that's where your savings begins. And of course, if you hold the loan until maturity, that's where the true savings is, where you're saving $36,000. Or if you take the $36,000 and you subtract it from your $6,000, which is your initial investment, you're actually saving $30,000. So it is important in order to do the math before you take any one of these options. And I guess the real question is, should you buy down your interest rate, specifically in the market that we're in right now, where rates are rising every single day? I guess the true question, or the true answer is maybe. As always, thank you for watching. If you have any questions, comments, complaints, or compliments, please leave them in the section below.